Hello, fellow Rebel Capitals. Hope you're well. So, the big news over the weekend and today, the United States gets its debt downgraded. I think it was Moody's that came out. I mean, this is a big deal. You're hearing it all over the news, just repeated over and over and over again, that the United States debt gets downgraded. This is crisis. This is a catastrophe. And Moody's is finally acknowledging what we all know, that the debt is totally unsustainable. The deficits are going to blow out. The Fed is going to have to come in and do quantitative easing, and that's going to make inflation just absolutely rip higher. And the release valve is going to be the United States dollar. So finally, Moody's is admitting the obvious, that this debt is totally unsustainable. That's the narrative. So, and another thing that you're going to hear, actually, you know what? Let's do this. I've got the screen share. Instead of listening to me ramble on, let's go right over to CNBC and you'll hear from the professionals what they think of the United States getting its debt downgraded. Here we go. What Moody's downgrade of United States credit means for your money. So we're going to go over what the normies are saying. We're going to go over what Zero Hedge is saying, the alternative media, if you want to call it that. And then I'm going to give you my opinion. We're going to connect some dots. And I'm going to tell you, well, I'll save that for the end. I'm not going to let the cat out of the bag. So Moody's downgrades U.S. credit rating, what it means for your money, key talking points. Moody's downgrade could push up borrowing costs for consumers. You see, this is always kind of the narrative that you hear over and over and over again. And it makes sense because, oh my gosh, if the United States is a bigger credit risk, then these lenders that are lending the United States government money, well, they're going to demand a higher risk premium. And that's going to increase rates. Rates are going to be higher than they otherwise would have been. And now, because everyone sees that the government is totally insolvent and we have 200 trillion in unfunded liabilities and the deficits are going to continue to explode. Now that this is out in the open, then interest rates are just going to go higher and higher and higher because these investors that are lending the U.S. government money are going to require a bigger and bigger risk premium. And then the United States is going to turn into an emerging market. That's really the bottom line. From credit cards to mortgage rates and auto loans, here's how it'll impact your wallet. The debt downgrade put immediate pressure on bond prices, sending yields higher on Monday morning. The 30-year trade above 5%. Wow. And the 10-year topped 4.5, hitting key levels at a time when the U.S. economy is already showing signs of strain. Of course, that's all Donald Trump's fault, according to the mainstream media. Bond prices and yields move inversely. Okay, we know that. Treasury bond influence rates a wide range of consumer loans like mortgages, as does the 10-year. And Brian Reeling says it's really hard to avoid the impact on consumers. Okay. So Moody's dropped it by one notch. Okay. In doing so, it cited increased burden of the federal government's budget deficit, Republicans' attempts to make President Donald Trump 2017 tax cuts permanent, as though Biden had nothing to do with this. Right. I love that. They come out and say, and look, I'll criticize Trump where I think it's due, and I'll give Trump credit where it's due as well. But to sit here and say that the United States debt is because of Trump, I mean, come on. That is completely laughable. And I honestly don't know how a media outlet could actually put that in print and believe that people would take it seriously. Like they're really going to say, oh my gosh, well, yeah, of course. I mean, no one would ever downgrade our debt. These deficits would be at zero. We'd be running a surplus if it wasn't for Donald Trump. I mean, we probably wouldn't even have federal debt. It would be at zero. We'd already paid it off if it wasn't for Donald Trump. I mean, Nobody is going to say that. Even the most, well, I got a bug here. I hate that when I get a bug in here. Anyway, but even the most, woke, left, delusional Democrat isn't going to say that. But the mainstream media will. Well, that's what they imply. When our credit rating goes down, the expectation that the cost of borrowing will increase, said Ivory Johnson. And Ivory is a financial planner. So you know that she or he or whatever really knows their stuff. That's because a country represents a bigger credit risk. The creditors will demand to be compensated with higher interest rate. You see, you'll notice, and I had a conversation with Snyder about this morning, which will be up on the Rebel Capitalist Interviews channel tonight. But their starting point is always that supply matters. Therefore, these deficits matter. Therefore, if future supply is going to increase, and this is what the downgrade of the credit is all about, then that means that, well, interest rates are going to have to go higher. And the people that are lending the United States money realize that there's going to be more and more and more and more and more supply of treasuries. And therefore, those interest rates are going to go up. That's going to increase borrowing costs for consumers. And this is going to lead to a big crisis. This is the narrative. Now, before we go any further, I want to remind you, this is not the first time the United States the United States debt has been downgraded by a credit agency. We'll get into that in just a moment. Downgrades can raise borrowing costs over time. And even the Atlanta Fed, Raphael Bostic, coming in and saying that he only expects one rate cut this year. Which consumer loans could see higher interest rates? Again, we're assuming that interest rates are going to go higher. This is the... You guys can see I get frustrated with this stuff. So let's just go back and take a stroll through history. I forgot. I'm sure I've got the tab up here somewhere. Looking for the 10-year Treasury rate. And we'll just go ahead and pull it up. Okay. 10-year Treasury yield. I visit it often, it says. Okay, then we'll just go ahead and we're going to zoom out. Now, let's go to some specific times based on when we've had these debt downgrades. That makes sense, right? Because, I mean, if you listen to the mainstream media, they make it seem like every single time we've had these downgrades, I mean, interest rates have skyrocketed because the United States is a bigger credit risk. And therefore, this time it's going to be the exact same. So let's go back to 2010 and we'll zoom in. So the first downgrade was 2011, August of 2011. So right around here. And you can see the 10-year Treasury yield was trading about 2.77%. Now look at that yield skyrocket because of the downgrade. I mean, think about how much additional in interest rate payments the average consumers had to make because of those interest rates skyrocketing because the debt was downgraded. And you may say to yourself, George, it doesn't look like the interest rate skyrocketed. And you would be correct because they didn't skyrocket. They went straight down. I mean, just look at this chart and how can you, it's like so many things in mainstream finance and economics is that everything that everyone believes in the mainstream narrative that everyone tries to push is completely absent of just looking at a chart. Like, in order to believe this, in order to push this, in order to buy this, you have to ignore what prices have done in the past. You have to ignore what the price signal has told you. In other words, you have to completely ignore what interest rates have actually done in the real world. You've just got to stay in your theoretical fantasy world. And you say, George, well, that's just 2011. Okay, let's go ahead and check the next time the debt was downgraded. That was 2023. I believe it was August as well. So we're going to shoot over here. In September, October, August. So we're right around 4%, right around 4.05. Now, you just fast forward, I don't know, a month or two. Do you see interest rates skyrocketing? I'd like to remind you that 2 years later, roughly 2 years later, the 10-year Treasury yield is trading about 45 basis points higher. Did it go up? Yeah. And then it came right back down. And I'd like to point out that the yield was going up prior to the downgrade. It's not like you had this downgrade out of nowhere. Then it's like, oh my gosh, these yields went from 3.4 straight up to 4.3 or whatever. No, they are going that direction. So I think there's a strong argument that the yield would have gone up over this little 3-week period, even if it wasn't for the downgrade. And then you see it fall right back down to sub 4, and then you just see it bounce around, but definitely not a trend higher after the downgrade. And obviously, we didn't have a trend higher here. We had a trend lower after the downgrade. So why on earth people would assume this downgrade is going to be any different? I don't know, because you have to ignore what happened in the past, which you would think experts would not do. But for some reason, they make a habit. In fact, that's what they're an expert at, is ignoring what has happened in the past, because it gets in the way of their narrative. Now let's go over to today, because as you read in that CNBC article, they were talking about how rates were skyrocketing this morning, which they were. And everyone on Twitter was talking about the 30-year Treasury. Oh my gosh, the 30-year Treasury is over 5%. It's over 5%. It's over 5%. It's over 5%. What's the Fed going to do? They've lost control. And it's only going to get worse. It's going to be this doom loop where rates are going to go higher and higher and higher because of this deluge of supply. Not only do we have the downgrade, but now we're going to have Scott Bessent coming out. Now Trump is talking about this big, beautiful bill that's going to increase the deficit by $5 trillion over the next 2 years. So here's what happened. This is a 5-day chart of the 30-year Treasury. And you can see when everyone got the news and then they wake up this morning, we start trading. It is absolutely true. Rates skyrocketed. They went straight up to, at one point intraday, let's just call it, well, let's just go to a daily chart. That's probably easier. And for some reason, I can't see it. Okay, we can eyeball it. Intraday, it got up, I call it 5.05. And then what happened? Wile E. Coyote. All the way down now to not just where it was this morning, but much, much, much lower at 4.90. So once again, they make the announcement and rates pop and then last for, over the weekend, let's say, and during the open on Monday, and then they just right back down. So of course you just get this knee-jerk reaction because of narrative. Oh my gosh, the debt downgrade, the debt downgrade, the debt downgrade. So sell treasuries, sell treasuries. So then of course what happens is the banks see you selling those treasuries, and what do the banks do? They come in, they say, hit me, hit me, hit me, hit me, hit me. And do you blame them? Because the banks don't care about the debt downgrade. They don't care about the inflation rate. They don't care about the fact that, the inflation rate could be at 6% or maybe even going higher. Or I think that is a correct statement. I'll go ahead and leave that for the moment. But they don't care that inflation could be running at 6% and the 30-year treasury is paying them 4.9. Why? Because they're just simply pocketing a spread. It's an arbitrage. They're not using their own money. So they're just getting free money. So I use this example all the time on my videos. I say, if I gave you $100 million, but told you that if you take this $100 million, next year, the inflation rate is going to be 6%. Would you decline the $100 million and say, no way. I'm not taking this $100 million. Are you kidding me? I'm losing purchasing power. How? You're getting a free $100 million and you started with no dollars. So the banks, the arbitrage play, it's the exact same thing. So my point here is it's a self equilibrating process where if rates go up like this knee-jerk reaction, the bank's like, hey, this is a better deal. So if I'm a buyer here, well, I'm definitely going to be a buyer here. And usually it doesn't happen this quickly, of course. But over time, this is what smooths things out to the point where these movements are really all about growth and inflation expectations, nominal GDP, whatever you want to call it. And they're not precisely pegged to nominal GDP, but the trend is there. So if you have nominal GDP that's going to be declining over the next, call it 5 years, you're likely going to see interest rates decline as well. Now, they never decline in a straight line. There's obviously a lot of noise. And I like to remind everybody that during the GFC, in fact, let's do that. That'll be fun. 30-year treasury. Let's just go back and see what happened during the GFC. We had 2007. Let's get into 2008. Okay, so right here, you can barely see it on the chart. But at the beginning of 2008, as we know, we were definitely in recession, even according to the NBER, although they didn't announce it until December. But from January, we were at 4.34. You go to another 6 months, and you're at 4.64. And this, I'm sure there's just a weekly or something like that. I'm sure intraday, there's a bigger than a 30 basis point move. And the reason I say that, because I know in the 10-year treasury, there's a 100 basis point move. So you have these moves straight up from, let's say, January of 2008 to June, July of 2008, where everyone is talking about inflation risk, inflation risk, inflation risk. And 2 months later, the Fed's at zero. And 6 months later, we're actually have deflation because of the biggest deflationary recession, debt bust, financial crisis that we've had since the 1930s. So you see what I'm saying is you can get it. You can get this much noise even in something like 2008. But eventually it goes back down and look at the trend here for the 30-year. It's going straight back down. If you look at GDP, nominal GDP, it's flatlines kind of here. But if you look at a long-term trend, it's this exact same thing. And then what happens to nominal GDP in 2020? When the government locks everybody in a cage and destroys the economy, shuts down global supply chains, hands out free money, stimmies. Nobody has to pay their rent, their mortgage. Well, nominal GDP skyrocketed. And then what do you think happens to the 10-year treasury and the 30-year treasury along into the curve? It goes up as well. But when it's going up here, notice it's not going up because of downgrades. It's not going up because of deficits. It's not going up due to supply of treasuries. It's simply going up due to growth and inflation expectations. So does that mean the debt, we just have this get out of jail free card, or the debt doesn't mean anything, or it's a free lunch? That, oh, well, then if we don't have to worry about interest rates going up, then I guess we can just spend. And George is all about MMT. That's usually the conclusion that a lot of people come to. Oh, well, George is just MMT. So I guess we can just spend as much as we want to. We don't have to worry about it. Screw those consequences. We have a money printer and we know how that ends. No, what I'm not saying is that this is a free lunch. I'm not saying there are no consequences to the government spending. There absolutely is. But the consequences don't show up in the bond market. The consequences don't show up in higher interest rates. The consequences show up in the economic distortions that the government spending creates and making the economy less efficient. So you still have to pay the fiddler. There is no free lunch. It's still going to negatively impact the poor middle class and society at large. Because the government spending that creates the deficit, that creates the debt to begin with, by definition, is creating a misallocation of resources. It's creating malinvestment. And then this, in turn, is making all of us poorer. That's the punchline. And if you go over to the total government spending as a percentage of GDP, look at this. And this includes state and local, right? So you can see how this is just going up and up and up and up and up to the point in 2018 where we were about 40%. I can assure you now it is way higher, way higher. In fact, I would say it's probably near 50%. And as these deficits get worse and worse and worse, which they absolutely will. I mean, trust me, I'm not saying that the deficits aren't going to get bigger or that the debt is somehow going to shrink. Absolutely not. I would say that we're at 37 trillion right now. I would not be surprised if in 3 years we were at 50 trillion. Wouldn't be surprised at all. And, a lot of people are talking about the deficits going to 8-9%. Forget that. I wouldn't be surprised they go up to 12%, 15%. I wouldn't be surprised if we have double-digit deficits consistently, even when we're outside of recession over the next 5 years. But that doesn't mean that interest rates explode. That doesn't mean that we have bond vigilantes. It doesn't mean that consumers have to pay higher percentages or higher interest rates. And you say, okay, then George, what's the problem? Because consumers are going to have shittier jobs. Because consumers are going to get poorer. So what if they don't have to pay higher interest rates? Their standard of living is declining. And that's, at the end of the day, the only thing that matters. And why is their standard of living declining? Because of the government spending that's creating the debt. So you have to compartmentalize those things, right? The problem doesn't show up in the bond market. The problem shows up in the economy. And people get it backwards. And then they go so far as to say, oh my gosh, if we could just get the debt to GDP down, then it would be sustainable. How do you figure? So what you're telling me is right now we're at 120% debt to GDP. So let's assume we bring that down to 75%. Now all of a sudden, we can just wave the flag of victory and say, awesome. Well, we've done it. We did it. We tightened our belt. We got that debt to GDP down to 75%. And now the government can go ahead and spend like a drunken sailor again because we don't have to worry about foreigners buying our debt because we've got a bid out there because our debt to GDP is so low. You're going to tell me that somehow is beneficial to the U.S. economy? No, that just makes things worse. It's just like giving that heroin addict a brand new credit card. Does that make it better? And all of a sudden, because he has a credit card with a zero balance? No, it makes it worse because he's going to buy more heroin. It's the exact same thing with the U.S. economy. So the main takeaway, at least my main takeaway, from Moody's downgrading the United States debt is not to point out that we have a problem in the treasury market, and therefore we're going to have to pay more interest rates. It's to point out and highlight the fact that we have a problem with government spending, and it's going to show up, and it has shown up in the real economy, which unfortunately disproportionately impacts the poor and middle class. All right, guys, I'm leaving for Orlando tomorrow. Rebel Capitalist Live is this week. It starts on Friday. So if you're in the area, if you want to take an awesome trip, hang out with some incredible people, like-minded individuals, and listen to some speakers, rub elbows with guys like Kiyosaki, Brent Johnson, Patrick Sresner, Rick Rule, Mike Maloney. I mean, there's so many awesome speakers that are going there. And what's great about this event is they're not really behind closed doors. All the speakers are hanging out. They're in the crowd. They're at the cocktail parties. They're just having beers with everybody, shaking hands, taking pictures, answering questions. It's really a neat event. And this event is going to be the best one that we've done so far, I can assure you. So you can get your tickets at rebelcapitalistlive.com. And on that bombshell, guys, enjoy the rest of your afternoon, evening. As always, make sure you're standing up for freedom, liberty, free market capitalism. See you in the next video.